All right, let's dive right in. We're going to talk about one of the biggest financial moves you'll ever make, buying your first home. And we're talking specifically to you if your credit score is kind of hanging out in that 620 to 660 range. It is such a huge deal, right? I mean, it's this massive milestone, a huge step toward building your future. That dream of finally getting those keys in your hand, it's a powerful one. And you know what? It is absolutely within your reach. If you're nodding your head right now, then listen up, because this is for you. You're in a spot where you can qualify for a mortgage, for sure, but the road to getting approved, it has some pretty unique bumps and twists. The good news is, they're all totally avoidable if you know what you're looking for. And look, I'm not trying to be dramatic here, but that is the stone-cold truth. When your credit score is in this moderate range, lenders are looking at your application with a much, much finer microscope. Your margin for error is razor thin. That's how much a single tiny error could end up costing you in extra interest over the life of a 30-year loan, $50,000. So the bottom line is this: paying really close attention now saves you an absolute fortune later. So why is this credit range so tricky? Well, while you can absolutely get approved, the whole process is just tighter. Lenders see it as taking on a little more risk, so every single detail of your financial life gets magnified. Let's get real about what this means. Lenders are going to go over your application with a fine-tooth comb. One little slip-up can easily bump your interest rate from, say, 7% to 7.5%. That adds up fast. Even worse, one mistake could knock your score right below that 620 minimum, and you get an outright denial. We're talking a potential difference of $50 to $200 more every single month. Okay, so let's get into the first big bucket of mistakes. And these all happen before you even start scrolling through home listings online. Think of this as building the foundation for your entire home buying journey. You gotta get it right. The single biggest mistake you can make is just sitting on your hands when it comes to your credit. Just assuming your score is good enough without actively managing it, that is a huge, huge gamble. You have to be your credit's #1 defender. Just take a look at what happened to Mike. He had a 645 score, totally in the qualifying range. But right before closing, he opened a couple of store credit cards to buy some furniture. I mean, who hasn't been tempted? His score dropped to 618, just 2 points below the minimum. And the result? His entire loan was denied. Heartbreaking. So, how do you avoid becoming Mike? You followed these 5 steps. It's that simple. First, get your full credit report and fight every single error you find. Second, keep your credit card balances below 30% of your total limit. Third, do not, I repeat, do not open any new credit accounts in the months leading up to this. Fourth, and this one surprises people, don't close old accounts. It can actually shorten your credit history and hurt your score. And finally, the golden rule. Make every single payment on time. No exceptions. All right, mistake number 2. This is a big one. It's focusing only on the sticker price of the house. That purchase price, that's just the tip of the iceberg, my friend. The real cost of owning a home is way, way higher. So let's imagine a $300,000 home. You're not just paying for the house. You've got closing costs, property taxes, homeowner's insurance, maybe private mortgage insurance or PMI. Oh, and you should probably budget at least 1% of the home's value for maintenance every year. All of a sudden, that $300,000 house has an extra $15,000 to $30,000 in costs tacked on in the first year alone. And that leads us perfectly into mistake number 3, not having enough cash saved up. Lenders need to see that you have a cushion. If you drain every last penny for the down payment and closing costs, it's a massive red flag for them, especially with your credit score. Let's actually do the math here. For that same $300,000 home, a 5% down payment is $15,000. Closing costs could be another $9,000. But here's the kicker, the part people forget: reserves. Lenders want to see that you have at least 3 months of mortgage payments saved up after you've paid for everything else. In this case, that's another $9,000. So the total cash you actually need to have in the bank, it's closer to $33,000. All right, you've done the hard prep work. Your finances are in order. Now you're ready to start the actual hunt. And this is where a whole new set of traps can pop up, from the second you start looking to the day you finally get those keys. This might just be the most common and emotionally brutal mistake of them all: falling head over heels for a house you can't actually afford. Going to open houses before you have that official pre-approval letter from a lender, you're just setting yourself up for a world of hurt. And Sarah's story is the perfect painful example. She spent 3 whole months imagining her life in this specific house, planning where the couch would go, only to find out it was $70,000 over her budget. A pre-approval would have focused her search from day one and saved her all that disappointment. So you've got your pre-approval. Awesome. It is so tempting to just go with that first lender, but that is a really expensive mistake. Not shopping around for your mortgage is like buying the very first car you test drive without even checking the price at another dealership. You are just leaving piles of cash on the table. And the difference can be absolutely staggering. Just imagine one lender offers you a 7.5% rate and another offers you 7.0%. I know it doesn't sound like a lot, right? But that little half a percentage point can save you over $100 every single month. Over 30 years? That adds up to more than $36,000. I mean, that's a new car, that's a college fund, all from making a few extra phone calls. Okay, you found the house, the lender gave you the green light, you are in the home stretch. But this is a very dangerous time to make any changes to your finances. That time between your loan approval and closing day is what we call a financial quiet period. You need to freeze everything. Seriously. And Jennifer's horror story shows you exactly why. She was approved. She was just days away from getting her keys, but she went out and bought a new car. That new car payment shot her debt-to-income ratio, her DTI, way up. The lender did one last final check, saw the new debt, and just pulled the plug. She lost the house and her earnest money. Devastating. So I know we've covered a lot of potential landmines, but the goal here is not to scare you. It is to empower you. So let's boil all of this down into one final actionable checklist to keep you on that path to success. Here it is, your 7-point checklist to avoid disaster. Number 1, get pre-approved first so you know your real budget. 2, actively fix and protect your credit like it's your job. 3, budget for all the costs, taxes, insurance, the leaky faucet. 4, build up those savings and reserves. 5, always shop multiple lenders. 6, freeze all major financial moves until the keys are in your hand. And finally, number 7, which ties it all together, choose a smart property. That means picking a home that will be easy to finance and will hold its value, not a major fixer-upper that might make a lender nervous. You know, buying a home with a moderate credit score isn't about getting lucky. It's about being prepared, being disciplined, and being aware. By dodging these common mistakes, you're not just upping your chances of getting approved, you're setting yourself up for a stable and successful future as a homeowner. The path is clear. The question is, are you ready to walk it?